this will be the parabolic part where the market will steepen as it gets closer and closer to the top, as more and more people buy into it. And that last stage, I think we're in the last leg. That last period, whether it be for 6 weeks or a month or whatever, it'll be straight up. And I think the things that will lead.
Welcome to the Rose Show podcast. Thank you for joining us. Today, I am here with David Hunter. He is a chief contrarian macro strategist with Contrarian Macro Advisors, and he has over 50 years of successful experience in the financial markets. This is our third time meeting. I'm so excited to speak with you today, David. How have you been?
Yeah, hi, Rosanna. Great to be back. It's been, like you said, it's been a year, I think, since we last did one. So great to see you.
Great to see you as well. It's always a pleasure and honor to speak with you, David. You have an amazing forecast, and we're going to go right into that. Let's just jump right in because I think everyone's excited to hear more about your forecast and your expectations. And last time we met, a little over a year ago, we talked about the melt up and then followed by a global bust. So since we met, there's been a lot of changes, new administration, new policies. We have America first. We're bringing back American manufacturing, tariffs, new investments in the United States. David, tell us, how has your forecast changed in any way?
Hasn't changed a lot, surprisingly, because those are all big changes. But I remain the biggest bull on Wall Street. I've raised targets probably more than once since we last talked. I'm sure more than once. I had raised my targets, just to kind of refresh everybody's memories. People who follow you. I was very bullish at the bottom in October 2022 when the S&P was 3,500. Called for 6,000 when most people were looking down, not up. Was told I was crazy. I raised my target from six to 7,000 range, and then raised it to 7,000 a year and a few months ago in January 24. Somewhere in 24, maybe September 24, I raised it to 7,500, and then in the depths of the sell-off in April, when everybody else was talking about the bull market's over, the bear market's beginning, and it's going a lot lower. When we were below 5,000, I raised my target to 8,000 on the S&P. So, people think I'm crazy doing this, but I think it's being borne out. Sentiment was just too negative. Everybody got so negative, and I saw it as a huge overreaction to the tariff news. My favorite saying through those few weeks was just let it play out. Meaning you guys are speculating on what the tariffs are going to do, what the end result is. And I said, a lot of this is negotiation. Just let it play out. And I think you'll see it's not nearly as dire as you think. And in fact, may turn out to be a very big positive. And ultimately, I think that's where we're headed. Ultimately, we're going to see lower tariffs around the globe. No, we're not going to get everything Trump wants. No, we're not going to, turn this thing totally into our favor. But ultimately, I think you're going to see lower tariffs across the board. And meanwhile, it seems like Trump is looking for kind of a baseline 10% tariff here, which will help with the deficit here. So I think that whole period where people got so bearish, and now we're back, not that far from the all-time highs. And I think you still see, Barron's, a week and a half ago, the headline was sentiments at rock bottom. Sentiment is still very bearish. So even though we've climbed, a huge amount in a month, investors are still kind of stuck in that view that, the economy is going to be much worse because of tariffs, and our trading partners are upset with us because of tariffs, et cetera, et cetera. and they think this is all just chaos. The truth is, if you look beyond the headlines and beyond the media's attempts to look at everything through a negative lens, we are accomplishing a lot of the goals that the Trump administration set out to accomplish, and they are very much pro-U.S. economy and will in the next few years, I think, solve some of our problems.
Well said. Very plausible scenario that you propose there. And I'm in agreement with you. I think that the rock bottom sentiment of the recent past, just a month ago, led to where we are now, and the market has rebounded nicely. Would you say, David, that we are in the beginning innings of a Meltup?
Well, I am always asked this, or people want to be critical about the Meltup comments I've had. People saying, you've been calling for a Meltup for 4 years or for 3.5 years or whatever. And I'll go, we had a Meltup in 2020 and 2021. You know, the market more than doubled in 21 months. That's a Meltup. So this is a second Meltup. And depending on how you want to look at it, you really have had a Meltup from the October 2022 low. What a Meltup means is a far steeper than normal rally or bull market. And yeah, the start of the October 2022 bull market probably wasn't steep enough to be called a Meltup. But from the October 23 lows to now, I would consider that a Meltup, and I think it's just going to continue to steepen from here. But those are just semantics. You know, I'm really talking about where I think we're in a final bull leg into a top. So the bull leg, you know, the correction was larger than I expected. The reaction to the tariffs took us down almost 20% in the S&P. I didn't expect that, but it just means you were going to have another leg. So instead of it being a leg that started in October 23 and ran to the top, you had another big correction, and so you have a third leg. So you had a leg from October 22 to October 23. You had a leg from October 23 to basically February, March of this year. And now you're starting that, you came out of that bottom, and this is a third leg. So we're well into that third leg. I don't think we're going back to 4,800. You know, there are lots of people thinking we're going to go to new lows or back and retest the lows. I don't think we're going near there. My guess is we're going to see, I think, and again, it can take any shape it wants. So this is just one view of what it could do. But I think it could go back to the highs here before we get any significant pullback. So you can go back to 6,100 plus on the S&P, and then maybe you get a 6, 7, 8% pullback, you know, back towards 5,700, maybe a little below or above that. And then I think you run to the top. So the parabolic part of the Meltup, I think, is still ahead of us. Probably kicks in after this next pullback, whenever that takes place. You know, it could pull back from here. I'm not saying it can't, but I think more likely, given how so many people are looking for a pullback now, that it probably goes back to the highs, which is a couple 100 points higher. And then you get that correction. And people are going to react to that correction as if we're going back to the lows. I don't think we're going near the lows.
It's an exciting forecast, I have to say. 5880 is where we are today, and to run up to 8,000, that is a significant run up, vertical, parabolic, as you describe. Now, I want to, before we dig into this Meltup and talk about the various sectors and the gold, the silver, the miners, and tech, I want to make a point to everyone that how you see it is that this is nearing the end of a 40+ year secular bull market. There are other economists that mark, this bull market from 2009 and some after the dot-com, but you mark it from 1982, which makes a lot of sense to me with the rise in globalization, the reduction in interest rates. Tell us more about your thesis regarding that.
Yeah, so a secular bull market it includes several cyclical bull markets. So we had cyclical bulls 82 to the early 90s, from the early 90s to 2000, from 2000 to 2008. Those are all or 2002 to 2008. Those are all cyclical bull markets. A secular bull market is where you have typically higher lows and higher highs all the way through the bull market. So each of the cyclicals doesn't correct back. The reason it gets confusing is because in 2008-9, we did undercut the 2002 lows. But the truth is, when you look under the surface, you were still in a secular bull market. I think it just undercut by not a lot. And there were lots of sectors that didn't undercut. So I date it back to 82 because that was really the beginning of the disinflationary economy we've had for the last 40 years. I mean, interest rates peaked out at 15% on the long bond back in 81 and started that move to lower rates in 82. That has been really the backbone of this secular bull market. As rates came down from 15 to basically 40 basis points on the 10-year back in 2020, so you fell, more than 14%, more than 1,400 basis points. As that happens, PE multiples go inverse to that. So we've had multiples go from single digit in 1982 to basically 25 in the last few years, and have been bouncing around, in the high teens and low 20s since. I think at the top we're going to see a higher, multiple that's higher than 25 probably later this year, and that will mark the top of that, what will ultimately probably turn out to be a 43-year secular bull market, because the 43-year anniversary will be August of this year. So it's a pretty good chance it's not going to get there before that. It could, we could have, it's going to go parabolic, so it could get there very fast, but that's a lot of room to travel in a couple of months. So, August might be a good day, but whether it happens in July, August, September, or October, I don't really care, or even later. We're in the final stages of what has been a very long bull market. Now there have been plenty of cyclical bear markets that made it feel like the end happened already, and then you came out of that. So people are using numbers like, from 2009, or some might date it from the dot-com bust in 2000. But in terms of the overall market, I think we had a secular bull starting in 1982. Some might even argue that it started in 1974, because you did have a higher low in 82. But again, I kind of I pair it up with that move in bonds. So it makes sense to me that this is a more unique full secular bull market that started in 1982.
Well said. Yes, it's been the greatest bull market in the bond market for sure. We've been seeing the rates go down, like you said, in the 15, the high teens, all the way down to ZIRP. I mean, we had like a negative interest rate policy, massive easing, QE, like nothing else historically. It's just been definitely makes sense to frame it from the 1982 or early 80s. So I have to ask you, if we're nearing the end of this secular bull market, would you say that we would be entering a secular bear market like 1929 to 1949, the Great Depression, or 1966 to 1982?
Yeah, but basically, if you've ended the secular bull market, then almost by definition you're beginning a secular bear market. That does not mean that it's all downhill from there. You will have, and as you know, I'm calling for a global bust, and that to be accompanied by a historic bear market that I think will be the largest since 1929. So I'm talking about 80% peak to trough in the stock market. Does it mean it's going to be 80? No, it could be 85, it could be 70. But something on that order, a very big bear market bigger than 2008-9 is what I'm looking for. And so, but that's a cyclical bear. From there, you'll have a cyclical bull coming out of that bottom. So let's say I'm right about 8,000. Let's just use those numbers. You know, an 80% decline is basically 1,600 on the S&P. If that's where we're headed, and then we turn around, the S&P could go from 1,600 to even 5,000 or 6,000 and fall way short of the 8,000 top that we had this year. So, and then roll over again and go through another bear market, et cetera. So it'll be a series as the secular bull market was a series of higher lows and higher highs. The secular bear market will be a series of lower highs and lower lows, ultimately. So, but it doesn't mean we'll have 1,600 and then go up to, let's say, I'll just say 6,000 and then go down below 1,600. You could for many years stay above that 1,600, but ultimately maybe out in the mid 2030s actually go below that 1,600. So that would be all within a context of a secular bear market, because I don't think any time between the top this year and the the mid 2030s, I don't think at any time will exceed this year's highs.
Oh, wow. Interesting. So this secular bear, although it can have cyclical bulls in that part, how long do you anticipate or do you forecast that could last?
Yeah, the cyclical bull or the secular bear?
The secular bear.
Well, and again, it's totally at this point, big picture, seat of the pants guess. So I could be off by many years, but my best guess is that we're looking at the post bust 2020. So that's probably 2027 to sometime in the early 2030s. It'll be a shorter up cycle, economic, rebound cycle. That might last 5 or 6 years. That in that you'll have a cyclical bull that can take the market back, like I said, from 1,600 to maybe 5,000 or 6,000, something like that. Maybe higher, maybe lower. But in that period, you're going to have very high inflation, I think, because of the response to the bust. The Fed and every central bank around the world will have to respond to the bust like they did in 2020 and 2008, except in a far bigger way because it's a bigger decline, bigger. It's called a bust for a reason. We're going to have a big financial crisis. They will be, even though they don't think they will now, and even though they won't want to, they will be forced to respond. It'll be either let the system just collapse or respond with massive money, and both fiscal and monetary, massive money and massive government fiscal response. They will respond, and you will get a subsequent rebound. But it'll also, with a lag, not right away, but with a lag, trigger a huge inflation cycle bigger than the early 80s. So we topped out inflation around 21%, I think, or near 20% in the early 80s. I suspect that the top in inflation this time will be closer to 25%. And so we're worried right now. We were, it scared everybody when we went to 9% a couple of years ago. The Fed's looking at inflation as public enemy number one because of that move. And they're, imagine what the sense will be when we go to 25%. So it won't happen overnight. It will take several years of inflation, ratcheting up. But I think by the early 2030s, whether that's 2031 or 2, I don't know, but somewhere out there, I think we'll see 25%. And if you get 25% inflation, that means interest rates will be back up above 20% probably. So certainly short rates. Long rates will probably be close to that too. That begs the question of how do we service our debt when we have trouble servicing it at 5%, how are we going to service it at 3, 4, 5 times that? So there'll be things happening along the way. Hopefully that we address some of the deficit, but the problem is in the bust, as I said, it's not just going to be money printing. It's going to be massive fiscal response. Again, use 2020 as a guide. We put out, I think it was something like 8 trillion in new government programs, new government spending to deal with the pandemic and the subsequent period after the pandemic, and 5 trillion in money. And I'm telling you, this time we could do 20 trillion out of the Fed, and who knows what the government side will be. Probably be double digit, could be 15 trillion, I don't know. That means deficits aren't likely to go down, they're likely to go up. If we have larger deficits than even what we have now, how are we going to fund that? How are we going to service our debt? So by the time we get to, there'll be a lot of hand wringing and worry leading up to it, even late 2020s. But by the time we get to, 2032, 3, 4 period, we could be in the period where it's, there's no ability to access the capital markets. They'll say, who in the hell is going to give the U.S. money when they can't service their debt? Once the spigot is shut off, and we'll have shut off the money spigot probably well before that. If inflation's in double digits, it's going to be very hard to print money, because once you get there, as you print money, you drive up inflation even faster. It becomes a losing proposition where the more money it becomes a Weimar Republic. The more you print, the faster inflation goes, and it's a self-defeating mechanism. So we'll have lost the ability to access the printing press somewhere. I'm guessing it'll be late this decade, early next, and then we'll lose the access to the capital markets. And at that point, it's like you have to live within your means. Living within your means also means servicing your debt. Servicing your debt will be larger than the rest of the budget all combined. I mean, you won't have the money to do any of that, and everything collapses onto itself. Like I said, my guess is mid-30s is when that happens. That's the true collapse of the system, because what I'm describing is going to be mimicked around the world. We're probably going to be the worst case in terms of how much money we print, and we are the one that everybody looks to when the crisis hits, when the bust hits. But everybody's in the same boat. Certainly China's in that boat. Certainly Japan's in that boat. Certainly Canada's in that boat. You go around the world, Australia, there's not going to be too many places that will be spared in that kind of environment. So this is a worldwide collapse that I'm talking about in the 2030s. But it's not 2030. People hear 2030s. The next thing I know, I have questions about, well, you're saying the collapse happens in 5 years. And I said, no, it's probably 10 years out, 9 or 10 years out. But in the meantime, there's not, it's going to be a rough time, because you've got this bust, which is, I define the bust as bigger than any recession we've seen since the Great Depression. We've had many recessions since then. This will be bigger than all of them, bigger than 2008-9, and accompanied by a financial crisis that's probably bigger than 2008-9, which means biggest in history. So that's not going to be easy. But I differ from, for instance, the Austrian crowd out there, that the Peter Schiffs of the world that are talking about a collapse now. That when we go down, it'll be the Great Reset and all of that we'll have a dire situation here. The difference between he and I, or the Austrians and I, is that I'm saying, as long as you have the printing press, you can kick the can one more time. And if we're going to have a bust, we're also going to have probably deflation in that bust. If you have deflation, you have almost infinite ability to print money. And in spite of what Powell has said and what others have said, how they don't want to go back there again. They don't want to go back to ZERP. They don't want to go back to massive money as a support system. When you're a policymaker and you're faced with a situation where the financial system around the world is free falling, you're not going to sit there and say, well, we can't print because we know what happened last time. You're going to say, we got to save the system. So it's easiest prediction I can make is if in fact we get a financial crisis like I'm expecting, the response from Powell is guaranteed. The response from the Fed is easy to predict because no human is going to sit there and say we can't save the system. They're going to say we have the printing press, we have to do it.
Survival. That is the key. And that is, even though the Fed doesn't want to do what they need to do, they're going to be forced, and they will do what it takes to survive and keep it afloat. But yes, we're on a current path of unsustainability. But I have to say, I prefer your forecast over the others because you at least give us some time. You know, we have a little time before this all comes down so quickly. And there's time for structural changes. And we're hopeful that maybe, you know, what's going on right now with the tariffs, with bringing back manufacturing and America first. And, you know, US dollar, like you said, I mean, it's the global reserve currency. There's no competitor with liquidity and stability to the US dollar, and they all look to the US. So as we hopefully strengthen with these new policies, maybe we can circumvent some of this. And that's why I want to bring us back to the present day and talk about inflation and tariffs. Now, I am of the opinion that tariffs are net deflationary. They're not necessarily leading to this high inflation that everyone talks about and stagflation. What are your thoughts on tariffs and their effect on our current situation in the next few months and years?
Yeah, I think, and some of it I think is because Trump brings out the negative views. You know, everybody's skeptical of what he's trying to accomplish, so they go to the worst case or the most negative scenarios, or they see things through a prism where they just don't see clearly. I totally disagree with the economic community and the Fed that tariffs are an inflationary thing. That they do cause a rise in prices, but it's a one-time rise in prices. They don't. It's not an ongoing inflation. And we're seeing, obviously, with what's going on with the 90-day pause in China and what we saw in the UK, et cetera, that the high watermark in terms of the tariffs are a negotiating thing. When he throws out the numbers, those are how a negotiator works. You start with your biggest demand, and then you work down from there. So I and again, I think that people aren't stupid out there. Wall Street's not stupid, but they are being very much colored by the view they have of Trump. And Wall Street's been anti-Trump for years, and the Fed's been anti-Trump, et cetera. So even though they want to think they're being objective, basically they're looking through everything through the worst case prism, or at least don't see clearly. And I think if they were really honest with themselves, they would understand that, yes, you could have a temporary rise in prices, but it also will lead to probably a recession as a result. It will lead to a softening in demand, and those prices will come down. Plus, you're selling short companies in this country, particularly, who have shown the ability to be handed all kinds of adverse situations for the last 20, 30 years, and to adjust their, whether it be through cost cutting, whether it be through, moving certain products around, pricing some products where they have elasticity, et cetera, but where you don't get the dire effect of the tariffs. A lot of it will be absorbed. And yet again, the negative prism says, well, you either going to see a big rise in prices that hurt consumers and bring on inflation, or you're going to get a huge hit to margins that's going to hurt the market. So they see it either way as a negative, when in fact, history tells you to have a little more faith in the U.S. Capital system and the U.S. corporations to be able to adjust on the fly and get this done. I mean, Walmart's a good example today. I think, even though they're telling you they may have to raise some prices, you're not going to see this massive increase in prices that everybody's anticipating. Now, auto's a little different. They get hit square, but I think Trump has been right in terms of saying, give this some time and let's see what happens, rather than just judge us all at face value at the beginning.
Thank you for clearing the air. I love when you speak, David. You make a lot of sense. Inflation, everyone knows inflation is related with increasing the money supply. I mean, these tariffs will have that one up, like you said, maybe some higher prices, but it's not going to be the contributor to inflation. So I appreciate that you mentioned that. And I do think people...
And frankly, I'm more worried about deflation than inflation. As I've said, the global bust will be a global deflationary bust. And again, we are very U.S. centric. I am certainly as a strategist, but we also have to remember there's a whole world out there that is struggling, and we've been kind of the stronger economy in an economy that's been pretty stagnant for a while, since the pandemic.
Yeah.
And China's suffering. I mean, China's not, before the tariffs, China's, if China were reporting things as we report them, you'd see they're in recession already, and they are seeing deflation. So, and China's obviously the number 2 economy in the world. The U.S. is probably, if all the numbers were straightforward, is pretty close to recession, if not in recession. And I think the tariffs probably, what we've seen in the last month probably does bring on a recession. So we may be in recession now, or I think we will be this summer. Those things, as we go through, I think are going to morph into something worse. As I have said, my global bust is a simple formula of leverage, massive leverage on the system to the tune of 320 trillion in borrowing around the world, and to the tune of our huge deficits here, our huge debt here, massive leverage, and it's both private and public debt, combined with a fragility below the surface that started with the pandemic. Yes, statistically, we came out of the pandemic amazingly well after shutting down the whole world economy for a quarter, et cetera. But below the surface, you look, and there's a lot of things that are not nearly as strong as they were going into the pandemic. So there's fragility in the system underneath the surface, particularly in the small business community. And companies were able to, as I said, they're pretty resilient. They've been doing things to kind of offset, but they also make them more fragile. So I think massive leverage plus fragility, plus what I think is going to be proven to be a central bank, a massive policy error on the part of the central banks. Central banks are still fighting the inflation war when I think deflation is the risk. And what do I mean by that? I mean that I'll just single out the Fed. They've been shrinking the balance sheet for 3 years now. They've been taking money supply down, letting things roll off. They are not providing new liquidity to the system. They play some games. There's certainly the repos have helped to keep liquidity in the system, et cetera. But we've had net negative money supply for 3 years. And that always leads to recession. And again, because of leverage, I think leads to something much worse. They're still thinking inflation is the big issue. And I get it. they got burnt in 2022. Powell was, telling you it was transient and that, that it wasn't going to last and that ultimately we didn't have to worry. And then all of a sudden inflation broke out and then we had the invasion of Ukraine and oil broke out. The next thing you know, the Fed had to tighten pretty aggressively, and they're still worried about their credibility. They're still saying we gotta show that we are very much inflation fighters, and he wants to pattern himself after Volcker. So I get what's causing it, but regardless of what's causing it, the Fed, and he's got his committee members pretty much on board on this, are hyper focused on inflation and seem to be ignoring the fact that the economy is softening and can all of a sudden, I mean, history shows you this happens with every Fed regime. They go, oh, everything looks, we're looking at things in the present, which means they're looking at back looking data, and everything's holding together. Yes, it's softening, and then all of a sudden, this things tank, and they're in a catch up mode. And because of leads and lags, that means they're 6-9 months or a year behind. We're moving rapidly towards that point. I think I'm guessing you'll see a cut in June. I thought we should have seen one in May, but if we don't see one in June, we'll see one in August or something in between, because I think the economy is going to be quite a bit softer by the time we get through midsummer. And so, but again, they don't seem to learn cycle to cycle. They're backward looking. They're trying to, dot plots and all of that is all about trying to connect data points that are by definition backward looking, and then giving lip service to the fact that there are leads and lags, but not really showing that you use that to judge policy. I mean, if we're going to be in recession in the next few months, I could be wrong, but if we're in recession or going to be in recession in the next few months, even if they got aggressive tomorrow, they'd be 6 months late. So I think they're going to be 6 to 9 months from here late in terms of what happens. And because of that leverage, that recession can turn ugly in a hurry. And be something worse than a recession, or certainly a severe recession. Right now, you talk to most Wall Street economists, they're not sure we're going to have a recession. And if we're going to have a recession, they think it's going to be very soft, very, very slight. So I saw this in 2008, September of 2008. Most of Wall Street said soft landing, no recession in sight. Weeks later, not months later, weeks later, we had Lehman Brothers and the biggest financial crisis in our history. That's how fast this stuff can turn from looking, benign to looking something pretty dire.
Well said. Thank you for that historical reference. Things move fast. Certainly. We know that there's been pockets of recessions. Manufacturing's been in contraction for 2 years. Small business sentiment has been absolutely pessimistic, NFIB. And there are a lot of small businesses that have folded and they're not coming back. And, there's a lot of fragility under the hood. People focus on the headlines, but when you go and you look under the hood, you see there's a lot of softening, as you say, David. Agree with you. And there has been a contraction in the money supply. So the Fed is always behind, it seems, and they're very backwards looking. But so I want to take that and ask you what your thoughts are on the 10-year. There's a lot of talk of concern how it's gone up. I think it's hit 4.5 yesterday. Now it's like 4.48. Since the Fed cut in the fall, I think it was in the high threes at that point, and it's gone up. So are you concerned that if the Fed cuts, the long end could blow out and increase higher?
I'm not at all. I'm not in that camp at all. I am completely the opposite. I really believe, as I said, the economy is weak and getting weaker. The Fed will have to respond sometime in the next 2 or 3 months, and I think sooner rather than later. And again, I'm not saying they're thinking that way now. They will change their thinking as they see this come to the forefront. So I think we have inflation still trending down. I think we still have the economy trending down towards a recession. that speaks to a much lower interest rate, not higher rate. And again, I keep repeating on X over and over, because the focus on the street and on social media and on CNBC, et cetera, is always on the Fed. And the Fed's not cutting, therefore rates are going up. The Fed doesn't determine rates. The bond market determines rates, and the bond market will move up, rates move down as it sees softening economy. As that becomes more and more obvious, particularly since the tariff announcements, you're going to see rates move down. I am not worried about this backup in rates. We also lose perspective or don't use perspective when we judge things. We're day to day, we meaning even Wall Street, but certainly retail investors. Mm-hmm. They're looking at a rate that went above 450 on the 10-year in this week, and they failed to understand that it was 458, 460, a week and a half, 2 weeks ago, 3 weeks ago. I don't know when that was. We were a month and a half ago, we were at this level, and then went down below 420, came back up to 458, then went down to 420 again, came back up here to 450. Every time it moves up, they act like this is a new move to new highs, when in fact you're in a trading range of rates. And I think the move out of that trading range is going to take us below 4% and ultimately down below 3%, probably by the end of the summer. So I'm very bullish on bonds at the time when sentiment on bonds is, like the stock market, very bearish. People are talking about 5% and 6% on the 10-year. I don't think we're going to see either one of those now. We'll see them, in a few years, we'll see those rates again. But I think ultimately the 10-year, probably between now and Labor Day, we'll see 3% and below. And then I think the rates will continue to move down. There'll be, backups along the way, but continue to move down to where you'll see a 0% 10-year in the bust, because there'll be deflation, because you'll be printing money to the tune of 20 trillion. What does that mean? That means the Federal Reserve will be buying up every bond in sight. Every treasury bond in sight, every treasury bill in sight, to be able to put 20 trillion out there. And again, that's a number. I don't know what the exact number will be, but if it's anything close to that, that means they're going to have to be buying bonds from everywhere they can find them, the dealer banks, to the tune of trillions. And so you'll have a buyer of last resort that will drive rates through the floor. It also means short rates will probably be negative.
Wow. Well, that's why you are a contrarian. You don't follow what Wall Street says, and you have a great outlook there. Now, let's get into the Meltup. Let's break it down for people. Let's talk about the various sectors: gold, silver, commodities, the miners, tech, the Russell. Okay, so what are your thoughts now with each of these sectors? Will we have a broadening rally? Will it be across the board? Everything runs up as people get so excited and FOMO kicks in and everyone wants to just jump into this market? Is that what you foresee?
Yeah, I think as it progresses, it won't happen immediately. This rally we've had, a lot of people missed it because they looked at it as a bear market rally, and that's still kind of the view out there. So it's going to start with some people jumping on board, and then as you move up, more and more moving on board. So the way investor psychology works is most people will be all in at the top. They're not all in at the bottom, they're all out at the bottom, and then they gradually move to being all in. So they're beginning to question the bear market rally thesis now. As we move to new highs over the course of the next 2 or 3 months, they'll become more a believer that this is a true bull market, and they'll start increasing their allocation to equities again. And then at the top, I'll be the one saying, we're at or near top, it's time to get defensive. And most people out there are going to be saying, you're wrong. Don't you see this thing has legs? Don't you see this is going to last for few years, and they're going to have reasons to believe that. It's people don't realize they think that at the top they're going to want to get out. They're going to say, they think their view is going to be like it is now, which is they're worried that they have one leg out the door, and they're saying, when do I run out the door completely? At this point, at the top, that's not going to be their view. Their view is going to be there's going to be enough convincing things to say this thing has legs and it can last. And I'm going to be saying, no, I may be wrong for a little while, but the risks are through the roof now, and it's time to get out. So I'm usually at odds with the consensus, as you know, at turning points. And I was at odds at 48, 40 or wherever we got down to in April. I'll be very much at, and I was very much at odds October of 2022 being bullish. I'll be very much at odds when I'm bearish at, whether it's 8,000 on the S&P. I may have to raise it again. I don't know that. But at this point, 8,000 looks like a good number. As things play out in the next few months, we'll see. But wherever it is, and I'm not saying I'll be able to pick the top. I'll be out hopefully early, but not very early. That's the goal, is to not be late, but also not miss a lot. But I don't guarantee that's going to happen. So anyway, but that is, very much the case, is that this will be the parabolic part where the market will steepen as it gets closer and closer to the top, as more and more people buy into it. And that last stage, I think we're in the last leg. That last period, whether it be for 6 weeks or a month or whatever, it'll be straight up. And I think the things that will lead will be tech still. I've been very consistent, and I have a 400 target on SMH, and it got down to whatever it got down to, under 170 or wherever it was in April's lows. And people thought 400 was crazy. I stuck to that and said, I'm very comfortable with that number. From here, it's maybe 60% or something, but there's a big run still in tech. The Mag 7 will be part of that. I think industrials will be a big part of it. So you'll see, the Caterpillars of the world, the XLI industrial index, the materials, the coppers and steels and metals will be part of it. Certainly precious metals will be a part of it. And again, people want to know, is it going to be step for step? Do the precious metals move up when the market moves up? I go, I can't tell you the precise path. You may have your bigger moves in metals while you have the pullback in the market. So the market, let's say the S&P runs to 6,100 here, pulls back to 5,700. It may be during that 400-point pullback that might last a few weeks or a month or less. I don't know. It might be then that you have the biggest run in the metals. It doesn't matter. Between now and the top, the metals are going to be a big performer. How they play week to week, I don't care. There's a lot of upside in gold. There's a lot of upside in silver. There's a lot of upside in the mining stocks. Copper, I have a $6 target on copper. The mining stocks got hit pretty hard in April. They're just coming back. I think they have a big run ahead. I think financials will do very well. The things that won't do as well, they probably go up because it's hard not to go up, at least some, will be things like healthcare, utilities, basic, the consumer basic, the staples, because they're more defensive. And certainly in the case of healthcare, they have policies that are going to hit them with this new administration. So I think those areas I would say are likely to underperform. But industrials, materials, consumer discretionary, the tech, all of those will do very well. Financials all will do very well, I think. So I just, people can get all negative here. I think they're making a mistake if they do. Now, again, it's if if we have a pullback here of 6 or 8, or maybe in the Nasdaq's case 10% before the final run, you're going to see that sentiment get very bearish again quickly. It's still quite bearish now, surprisingly. But if we get a pullback, it'll probably be from higher levels than this. But then that kind of a pullback, people will be right back to telling you the top is in and we're going lower. So that's what refreshes this thing and gives it legs. What you don't want to see is everybody all in. That's when you start having to say, well, I don't know what the number is, but we're getting close. That's really what I would say. When people say, what do you look for at the top? The biggest thing will be that all-in sentiment. When everybody's bullish and telling you this thing has legs, that's when you should start getting skeptical. Not necessarily that it'll roll over right from that point, but it means you're in the high-risk area.
Well said. Absolutely. There's a saying about the shoe shine boy giving you stock advice. When everyone's bullish and, you have your mother-in-law, your mom, everyone telling you about all these stocks, that's the time that you need to start, thinking of risk management. You need
that actually goes back to Jesse Livermore back in
okay.
late 20s and early 30s. So
wow, I know.
Before the 29 crash, you had that's exactly what he said. You had the shoe shine boy telling you what stocks to buy.
That's it. Yeah. Well, then you need the bears to help fuel the bull. Everyone's a bull. You're at the top or right near it. So thank you so much for that. So you see yields coming down. That means you must see the dollar coming down during this phase as well.
Yeah, I think I've been a bear on the dollar for quite a while, and it had that run up to 115 a few years ago, and then rolled over, went from 115 down to par over a couple of years, and then bounced back to 109, I think, maybe 110. And at that point, which was earlier this year, I think, I had a lot of people questioning how this thing's going. They said it's going back to the highs, and how can you be bearish on the dollar? And now we're right back down to basically 100 on our way to, I think 82 is my number. I had an 80 number. I've moved that up to 82, but that's a big drop from here. It's not the end of the dollar as reserve currency. It's just what we see in these periods of bull and bear markets and currencies. The counter currencies like the euro, the yen, the Canadian dollar, the Aussie dollar, all of those things I think are going to be moving much higher versus the dollar over the next 6 months. And so, I've got 82 on the dollar. I've got 130 on the euro versus the dollar. I do the yen versus the dollar, not the other way around. So my number doesn't fit with what most people look at. But I think the yen can get up to 0.85, 0.0085. I think is the number I have. So that was down below, down under 0.00060, I think, at one point. So that's a pretty big run. The Canadian dollar, I think, can get back to 90.95 versus the dollar. And that had been down under 0.7, down in the 0.687 area. The Aussie dollar had gotten way down, and that can go back up to 0.85. Is below 0.7, probably 0.63 now. So those are big runs for the counter currencies because the dollar will be heading south. And again, it's not that other rates won't be coming down, but our rates are going to be coming down faster than anybody's, I think, is part of the story. And also, the weak economy. I think we're going to see this pocket of weakness this summer, partly in response to the tariff story. When you shut down trade like that, it does. There's some pain before the gain. I mean, it's not an easy thing to solve 40 years of bad policy. We've destroyed the guts of our manufacturing in this country, and that's what Trump's trying to restore. That doesn't happen with a flip of the switch. There is pain before you get to the gain. And frankly, I think some of the bust is going to be a result of the the tariff policy. So I'm not saying that the tariff policy is all roses. There, part of the pain is probably in the bust. I think we would have had a bust no matter who was president and no matter what policies, because it's a global bust. But certainly, I think the tariff, story is contributing to the weakness that we'll see probably starting late this year. We'll see weakness in the economy, but the bust could start as early as late this year.
Okay, so you started speaking about this catalyst, what could be causing this bust? And that was my next question. So we could foresee a bust occurring towards the end of 25, maybe as late as early 26. And so catalysts, besides every bull piling into the market, just everyone's just so bullish and so excited and sentiment has changed. Fed would be cutting probably as well. So the catalyst that you foresee, because there's a lot of fragility under the surface and the global bust refers to the economy, not the market. What are some catalysts that we can watch out for? You think the tariffs, anything else that you're thinking about?
Yeah, just so because I think the big elephant in the room, the real question I need to answer before we get to that is what, because all I've been doing is talking about how bad things are going to get. And then that begs the question, how can you be so bullish on the stock market when you're talking about a recession, either, already being in a recession or starting this summer, and, the tariff news leading to a bust, and or the tariff policy leading to a bust, and all the other negatives you're throwing out there. Why would the market go to 8,000? And why would the NASDAQ go to 27,000? And why would the Russell go to 3,300? And the answer is
to be continued.